Welcome to the mortgage broking episode about Introduction to Residential Property Transactions series. These videos aim to give those who are new to the residential property industry an overview of how the house purchase process works, explain who is responsible for doing what and why they do it, and hopefully to provide some simple tips that we can all follow to make the process easier and hopefully less stressful for everyone. Today, I'm delighted to be joined by Jane King of Ashridge, who provide independent financial advice and mortgage advice to clients across London and the South East. Jane, thank you so much for joining us today. Could you start by introducing yourself and just explaining how you got into mortgage broking?
Yeah, well, my name's Jane King. I'm an independent mortgage and equity release advisor with Ashridge Private Finance. Like a lot of people, I sort of fell into the industry by accident. I started off joining an IFA practice back in 1996 as an administrator, and then decided to take all of my financial planning exams in around about 2003. I was also doing some part-time work from an estate agent at the time and realised I actually really loved working with property. I found the IFA pensions, life assurance, a bit on the boring side. So I decided that I would go into mortgages, and it was just at a time when they were becoming regulated. So I took all my mortgage exams, followed it up with an equity release qualification as well. And I sort of see my role as someone that I form. My clients say to me, we form a very intense relationship for a very short period of time. And I think my job is to make sure that they get the best advice on their journey, all the assistance that they need, and hopefully make it a fairly smooth process, or as smooth as it can possibly be.
And do you think, Jane, that some people think that, somebody who provides mortgage broking assistance is only for the very wealthy or only for people who are buying a very expensive house?
I think it's a bit of a myth. I do everything from a £25,000 shared ownership mortgage right up to a £2.5 million. Everyone gets treated the same in our book. We don't charge fees, so it doesn't matter whether you're rich or poor. We get paid by the lender. We don't charge you any more. So I think most mortgage advisors will do everything from the small. I mean, there are the firms that only deal with the big stuff, but most of us are more than happy, and it doesn't matter. All we're interested in is that you get the best advice that you can, because it is a minefield out there.
See, that leads neatly. You said it's a minefield, Jane. Can you just explain briefly the different types of mortgage that are available? And I'm just going to put this into context. This session is being filmed on the 26th of September 2022. Mortgage products do evolve and change, so please bear in mind that what Jane is going to tell us now might not be absolutely correct in 2 years' time.
Yeah, it might not be correct in 2 hours' time, the way it's going at the moment. Well, basically, there are three different types of mortgages. The first one, and the one that I think everybody knows the best, is the fixed rate. So you can fix your mortgage payments for a set period of time. It's normally 2, 3, or 5 years, although now we do have lenders that have bought out much longer term. So those that want the peace of mind of 10, 15, or even 25-year mortgage now have that option, that they didn't have maybe 5, 10 years ago. So fixed rates are the most popular. You can fix your monthly repayments. Then we have the tracker mortgage, which has been causing all the hoo-ha at the moment with rates going up, because the tracker mortgage is a rate that is guaranteed to track the Bank of England base rate. So when that goes up, your mortgage will go up, and when it comes down, your mortgage will come down. And then the third one, which isn't quite as well known, is what is called a discounted rate. And this is another variable rate, but it's a discount on the lender's own internal standard variable rate. So it's much more volatile, because although it tends to track bank base rates, it doesn't have to. So the lenders will have a meeting once a month and say, right, what are we going to do with our standard variable rate? Are we going to leave it where it is? Are we going to up it, or are we going to reduce it? And depending on that decision will depend what happens to your mortgage rate. So it's much more volatile. It's usually offered by smaller building societies who rely on their savers funds for mortgages, so they don't go to the open market. And so they are sort of dictated to by how desperate they are, I suppose, for savers funds. So if your mortgage application is a little bit off the norm, and we find that we have to go to a smaller building society, maybe it needs a more flexible view, then the discounted rates you're more likely to find there. So they're the most volatile, and then we have the fixed rates, which are the most stable and the ones that most people like to have.
And so we've got fixed rate, we've got a tracker, we've got a discounted rate.
Yeah.
Interest only, Jane?
Interest only is not for the faint-hearted these days. Not many banks offer them. If you do want one, then a lot of lenders now that do offer them will insist that you have a great big lump of equity in your house at outset, maybe £200,000 or £300,000 before you've even started. Or they may want to see a savings vehicle where you've already got the amount that you want to borrow already available, so either in investments or your pension, or some sort of other sort of savings, or the sale of your second property. So sale of the mortgaged property that you're borrowing against is now much more difficult. And also to actually obtain the interest-only mortgage in the first place, you normally either need a large salary and bonuses, or you already need that amount of money in place. So very difficult to get. You will not be able to repay your capital just by using cash. So if you want to do interest only, you have to be able to take an element of risk with your investments in order to pay it off. It's normally around 7% a year, which you're just not going to get on cash. So you do need to be not risk averse if you're going to consider interest only.
Okay.
And definitely not for first time buyers. Definitely not for first time buyers.
But still used for buy to let quite commonly, Jane?
The only way for buy to let most people, buy to let is a different kettle of fish because it's treated as an investment rather than somewhere for you to live. They're calculated on an interest only basis. If you want to overpay them, you can. So you can make payments off of your capital to pay down your buy to let. Not particularly tax efficient thing to do, because the whole point of a buy to let is that you borrow as much as you can against it in order to buy more and more properties, but they are always calculated on a interest only basis.
Okay. And do all mortgage brokers have access to all mortgage products from all lenders, Jane, or are some people only allowed to recommend some lenders, or how does that work?
Yeah, there are 2 or 3 different types. So obviously, if you go direct to your bank, you are only going to get information on the products offered by your bank. They are not going to be able to advise you on any other lenders. And then we have other lenders, typically attached to estate agents or maybe smaller brokerage where they're part of a panel. And because they're part of a panel, they can only offer a limited number of mortgages from a limited number of lenders. And then at the top end, we have what you might call whole of market. They are totally independent, and we have access to pretty much every single lender in the market. And there are lenders that although we can access their rates and products, we cannot actually use them for whatever reason. But if we know that they are the best deal for you to have, we can refer you to go directly to them or refer you to another firm that can use them. But directly authorised and large networks have access to all of them, and they are the firms you want to go to that are wholly independent with access to the whole of the market.
Okay, brilliant. So just as a brief recap for our listeners, so if you go to your bank, you are only getting access to their products. If you go via your estate agent or to a smaller insurance broker, a smaller mortgage broker, you're only going to have access to a limited range of product. But if you go to a mortgage broker who's what's called open market, they will be able to access the majority of offers.
Correct. There'll be a whole of market or independent. Yeah.
Whole of market. Okay, that's brilliant. And you mentioned earlier on, Jane, how you get paid. Could you just explain that in a little bit more detail?
Sure. So we are allowed to charge fees on top if we want to. So some brokers will charge you a fee and some won't. Every single mortgage advisor, when your mortgage completes, we get paid by the lender. Mm-hmm. It's called a procuration fee, and it is a percentage of the loan that you take out. When you get your mortgage illustration from your advisor, you will see quite clearly what the procuration fee is. It's printed on the illustration, so everything is completely transparent. Some firms of advisors will then charge you a fee. So they'll either charge you at the beginning of the process, on the production of your mortgage offer, or when your mortgage completes. And it is usually either a fixed fee, so it will be a one-off payment, or it will be a percentage of the loan. So typically it will maybe up to 1% of the loan. They have to tell you up front, right at the start of the process, what their fees and charges are. And of course, some firms of advisors do not charge any additional fees at all. So whether you're prepared to pay fees or not, it's up to you. But there are all sorts of different ways in which firms charge. Some are free, and some, as I say, will charge up to 1% of the loan.
Okay. Is there a sort of general rule of thumb about charging a fee, Jane? So if it's perhaps a more complicated borrowing requirement, would you expect fee to be applied, or isn't there really a rule?
Some advisors that do unregulated, so maybe they're doing very complex buy-to-lets or commercial, or maybe a landlord that's got 20 properties, something like that, then maybe they would charge. But with normal residential mortgages and the odd buy-to-let, my experience is, I mean, obviously we don't charge fees, but my experience is that most that do charge fees tend to charge a fixed rate, a fixed one-off fixed fee, rather than a percentage of the loan. So ask what that fee is in advance. But I think it's more important that you get on with your advisor. And if you really like the person that you're dealing with, the fact that they charge a fee shouldn't really put you off.
Okay. And what point in the process should a buyer talk to a mortgage broker, Jane?
I think, well, I like my clients to come and see me about 3 months before. Okay. You want to know how much you can borrow. You want to talk through the options. Hopefully you can put a monthly budget together so that you can sit down with your advisor and say, look, we've thought about it, or I thought about it. This is how much that I feel I'm comfortable spending every month. So you can have a look at all of those questions. Things like looking at your credit file to make sure that there's no blips on there. All of those things can be dealt with in advance. So I would say a good 3 months before, and then you can go out and look for your property, knowing exactly what you can afford, a clear idea of how much you can borrow, rather than running around trying to find houses and then ring up the estate agent and then ring up your mortgage advisor, you know, when you found something on Rightmove and you want it tomorrow. Basically, which is actually what happens quite a lot. But in an ideal world, 3 months, 2 to 3 months is fine.
And I think one of the key things, and I know I've done this myself, I've started looking for a property. I've found my dream property, fallen in love with it, been to view it twice, then spoken to my mortgage broker and found out that I haven't got hope in hell of being able to.
Yeah, it is. I mean, I do sometimes get a call on a Saturday when somebody's walked past an estate agent's window and said, oh, we really must have this house, Jane, how much can we borrow? And it's, well, you know, I can't tell you off the top of my head. But yeah, the earlier you can go and formulate a plan, the better it is.
And you mentioned that credit scores, credit reference. In addition to that, what documentation does a buyer need to provide, either you as the mortgage broker, Jane, or the lender?
The most important things are a copy of your credit file, obviously, at least 3 months pay slips, and if you're self-employed, at least 2 years self-assessments, 2 years tax returns. You also need to evidence your ID, so you're going to need a current signed passport or a driving license with your correct address on it. You'd be amazed how many people send us driving licenses that have still got their parents' address on, or bank statements that have got a previous address on. You must make sure that all of your, you know, addresses are current and up to date. All your paperwork matches. So we need those things. If you're buying something brand new, then obviously we need a copy of the new build paperwork. If you're buying down the affordable road route, then you need your shared ownership or your help to buy paperwork. So we need that sort of thing. Solicitors' details, because obviously you're going to need a conveyancer. Bank statements, pay slips, passport, that sort of thing. And that's about all you need to start off with. You may find that a lender asks you for further documentation further down the line, but that's all that you need to start. But you do need to make sure that it's all in order. As I say, correct address, correct name on it, the name of your employer is on your payslips. because all these little niggly things can result in a lender turning around and saying no. So it's best to get them all in order at outset.
Yeah, and they can, of course, add time to the process, particularly if you've got to go and get your address updated on your driving license.
Absolutely, yeah, it can take weeks. Yeah.
And how do lenders ensure that a borrower can actually afford a mortgage?
Well, all lenders have calculators, which we will use in the first instance to make sure that you can afford it, that we feel that they're looking at the fact that you can afford it before we even submit the application. Once we submit the application, the lender does take quite a lot of time to make sure that all commitments are covered. So there's lots of questions in the application form. What are your commitments? Student loans, car leases, all that sort of thing. They also make an allowance for what you would call your committed outgoings once you move. So things like electric, gas, water, you're not going to know what that's going to cost. So they take the Office for National Statistics average so that they can just allow some of your income towards your commitments. Then they will take maybe an allowance if you've got any financial dependence. So if you've got children, they will make an allowance for that as well. So all these things will be deducted, and they're usually written into the application process. So when we go to do the calculations, all those little extras, for want of a better word, will be deducted by the system. And then at the end of it, it will come back and let us know whether the mortgage is affordable. Now, as long as you haven't missed anything, and you'd be amazed at what people miss out. It could be anything from a student loan to an old gas bill that they've forgotten about. Assuming that all of that is done, then it should marry up with the application process, and it should be fine. But it is important to make sure that you haven't overlooked anything. But the lenders do take quite stringent checks to make sure, and also they will stress test the mortgage to make sure that it's still affordable, even if interest rates were to go up.
And obviously, right now, where we're in a situation where interest rates are rising very quickly, that's incredibly important.
It is, yes, yeah. Well, it's also important for the buyer to know that they can afford it if rates go up, because they don't want to be able to afford it now, and then it only takes one small increase in rates and suddenly it becomes a bit of a burden. So yeah, it's good for everybody.
Yeah. And how long is a mortgage offer typically valid for, Jane?
So once you've got your mortgage offer, a lot will depend on the type of property you're buying. So a normal standard mortgage offer will last 6 months from the date that it's produced. Now, a lot of in the past, a lot of lenders would allow you to extend your mortgage offer. They don't do that anymore. So once your 6 months is up, you have to start again, unless, of course, you're purchasing a new build. Now, as we all know, with what's happened in the past with COVID, a lot of new build developments have been pushed back. There's a shortage of supply of building materials. So some developments have been pushed back 6 months, maybe up to 9 months. So what lenders are doing at the moment is they are issuing extensions. So if you're buying a new build and you don't complete within 6 months, they are a lot more sympathetic to issuing you with an extension. And then you get some remortgages, mainly from some smaller lenders, and they will only last 3 months. But as a standard rule on a purchase, it's about 6 months.
And when we talk about a mortgage offer, Jane, we're talking about something there that's specific to a property. So if I want to buy 25 Acacia Avenue, the bank has considered whether that property is suitable for lending purposes via some kind of mortgage valuation, and that offer then applies to that property. Is that correct?
That is correct. If you want to change your property, we have to let the lender know. If we have to change the property address, or we have to change the property price, or we have to change the amount that you want to borrow, or in the event that you're purchasing a new build and the postcode changes, then all of those things, we have to go back to the lender and ask them to re-underwrite the case and issue a new revised offer. So you cannot use the one that you've got if there are any changes made. And your solicitor will normally pick up on that fact. But if you know that there's going to be a change, then it's best to come back to us as soon as possible, and then we can get it re-looked at.
Okay. And the reason I raised that question was because we always also have what's called a mortgage offer in principle. I think that's the correct terminology. Is that different to a mortgage offer?
Yes. Okay. So a decision in principle is what the estate
Decision.
agent will keep banging on about when you go to look at a house. Have you got a decision in principle? Have you got a decision in principle? So a decision in principle is something from the lender that says that on the day that the decision in principle is applied for, they are prepared to lend you the amount that you have requested based on the information that you have provided. So it's all verbal, there's no paperwork, it's just they search on your name, address, and date of birth to make sure that you exist. They take your income as said, so they don't ask for any proof. Your commitments will come up on your credit file, so they'll ask you about those, and then they will issue a yes or a no. So it will just be a matter of confirming who you are, taking a look at your credit score, and then saying, well, based on all of that information, yes, we'll lend you what we want. We'll lend you what you're asking for, or no, we won't. But it still has to be backed up with a full mortgage application. It's probably meaningless the next day, because if the next day you go out and you spend a couple of £1,000 on, I don't know, on a car or something, then that decision in principle is then worthless. So they're only really valid on the day that they're done, but a lot of estate agents like them because it means that at least one step has been gone through to evidence that you are capable of borrowing, you know, what you said you can borrow.
Okay. So it's definitely not, that definitely doesn't mean that somebody is guaranteed to get a mortgage for that amount.
No, in fact, a lot of the time the estate agents now would rather just ring the advisors and have a quick chat with those, because they'd rather hear that you've met them and had a meeting with them and gone through all the calculations, and the mortgage advisor has said, yeah, you know, it all looks good to me, perfectly straightforward. They would rather that than someone that's done a decision in principle online with a lender. You can make stuff up when you do a decision in principle online with a lender. You can lie about your salary. You can do whatever you like. So they're not that valid, but a lot of estate agents just like them anyway. But no, they're not a guarantee of an offer. It still has to be underwritten, and the valuation still has to be done.
Okay, so I think you provided some really important guidance there, Jane, for estate agents, which is, you know, pick up the phone to the buyer's mortgage broker and ask a few questions.
Absolutely, yeah.
Particularly if you've got a house that's, you know, got several offers on it and you need a way of assessing who's realistically able to proceed.
Yeah, absolutely.
Okay. And once the buyer's got their mortgage offer, so they've made the offer on the house has had some kind of mortgage valuation done, the buyer's got their offer. What's your role from there through to completion, Jane?
So once your mortgage offer, it's not legally binding. It's binding as long as your circumstances don't change. So if you were to lose your job, or you were to go long-term sick, or something else, or you were to get some adverse credit, for instance, and the lender found out about it, they have the right to withdraw the offer. So although it's legally binding, they do have rights to withdraw it under certain circumstances. Once you've got your offer, as we've already discussed, it's normally valid for about 6 months. And then everything moves then to your solicitor, and they will look after your exchange and completion dates. Now, often we get asked to do ID checks, because if we've met the client, we can certify their ID. So often we're asked by the solicitors to do that. Sometimes we're asked by the solicitors to maybe change some information that only we can do. So as we mentioned before, if there's a change of purchase price or a change of mortgage, then we have to go back to the lender and ask them to make all of those changes. So we carry on liaising with estate agents and the solicitors right through until the completion date, if our clients want us to. If they don't and they're happy with it, then that's fine. And obviously with a new build, you have to exchange very quickly. So sometimes we're not needed anymore, but we're always around as and when we're needed, right up until completion.
And if the conveyancer needs to know or needs a piece of information from the lender, Jane, do they come through you to get that, or do conveyancers tend to deal with lenders directly?
There are some things for which a conveyancer can only deal with the lender directly. So for instance, as advisors, we don't get access to the lender's legal department. So if it's a legal issue, then the solicitors have to go direct to the lender's solicitors. But if it's a mortgage issue, so as I said, changing purchase price or some such thing, then the mortgage lender will say, well, you're going to have to go through underwriting. And so they will come back to us, and we will go back to underwriting and ask them to make the relevant changes. So it will depend on the nature of the query.
Okay. And I think a point that you made earlier in that section that's really, really important is if the buyer's circumstances change after the mortgage offer is received, in many cases they are duty bound to let their lender know that. So if they lose their job, for example.
Well, they are duty bound, and it says on the offer that they're duty bound, but you would be amazed what a lender can find out about somebody without them even knowing. As an example, I had one about 2 years ago where an applicant had resigned from their second job, and the lender rang me up and said they were having to withdraw the offer because the applicant had resigned from their second job, and now the case wasn't affordable. Now, I don't know to this day how they knew that client had given up their second job, but they knew. So the lesson to be learned is, if your circumstances do change, you should let your lender know, because the chances are your lender's going to find out. So yes, you are duty bound, and if you do lose your job, or you are, you do discover that you're suffering from a long-term illness, you wouldn't want to take on a commitment like that either. It's not in your interest to take on that commitment, because you're not going to be able to sustain it in the long term anyway.
Okay. That's all of the formal questions, Jane, and that's been a really, really, actually, personally for me, it's been a very, very useful insight, and I'm sure all of our listeners will find the same. Is there anything else you wanted to add, Jane, or anything you think that's really worth highlighting?
I think the only thing I would like to highlight, is the value of actually speaking to an advisor. You're probably not going to move maybe more than 2 or 3 times in your lifetime. So don't waste your time trying to become an expert at it for the sake of 2 or 3 years. You've got more interesting things to do with your life. So go and see an advisor. We won't bite your head off. We're not going to bombard you with jargon and all the rest of it. We're actually really nice people. We just want to help you. So don't feel intimidated, but do please take advice. There are a lot of lenders out there that aren't on the high street that will only deal with advisors, and we want to make sure that you get the best possible deal that you can get. And so I would say, family recommendation or a Google search, but do please take advice, especially that, at least if it's the first time that you do it.
That's brilliant. Thank you very much, Jane. Thank you very much for your time today. I'm very grateful. It's been very, very interesting.